Hello, welcome back to Harvesting Income. Hope you're all doing well. There was a question someone asked me, what are the different investment choices or options available for an income investor? So that's what we're going to discuss in this session, and I'll also give you a quick idea or a guide. However, this is just an introductory answer to this question, and this will open up a lot of new areas and topics as we go on. At first, I'm going to tell you the goal of an income investor, and then from there, we'll move into the different options. So, what are the income investing goals? There are primarily two goals. You can just break it into two. One would be generate income, obvious, the name itself says income. And second would be grow investment value. Now, I've just broken it down a little further to give you an idea of what are the different options. One would be generate regular income. Let's say you invest in something and you get a regular income. For example, you invest in a property and you get rent. That's a regular income. However, there is an additional point there that grow the income. You want to grow the income as well because you want to beat inflation, beat the cost of living, so that you can keep your money value constant and growing over time to meet the expenses or your requirements or goals. So that is helping you achieve your financial goals. The second aspect is growing investment value. Like, for example, if you invest in a property or invest in a bond, you want to make sure that the value of the investment stays preserved. Like, you don't want the value of the investment to go down. That is called preserve investment value. Second aspect is you want to grow the value of the investment over a period of time. So growing investment value would mean like increase in the price of a stock or increase in the price of a property, or the value of a fund goes up, and so on. So, so, so broadly, there are two: generate income and grow your investment value. However, there are a little bit more dynamics when you go further down. I will first break down some options we have. First would be the equity market, which you will see on the next page. What are the different choices available in the equity market? So here we would have you know uh, three or four broad categories. We have four here, but not everything will suit every individual. I'm just going to explain each of them broadly, but you can take your pick, whatever suits you, or you can take advice from financial advisors. The first one is pretty obvious: stocks. Let's say you invest in a company's stock, like you invest in Apple stock. The price of the stock goes up, and obviously you're making a gain there. Like the value of the investment goes up. So as we discussed in the previous slide, you're growing your investment value. At the same time, let's say the company declares a dividend, like you get a share of the company's profits. So in that case, you're making an income. And imagine that the company pays dividend on a regular basis. So you're making income there. So again, just want to reiterate the same points. So one is you're making income. Let's call it I, which is like a dividend. So that could be paid every quarter or month, depending on the stock. And the other would be the you have capital appreciation, CA. The price of the stock goes up. It can go down as well, but we hope for the prices to go up, right? So, so those are the goals that we are trying to achieve here by investing in these stocks. And we choose blue chip stocks, like, or high quality companies, not any random stock, because we want to make sure that the company is able to generate that income and pay you that income as well, and also maintain its stock price or value over a period of time. So now that we have covered the first one, we move to the second one, which is the index ETF, or index exchange traded fund. Index is basically some um, kind of a model which tracks the value of a basket of stocks. Let's say you have one stock here, one stock here, one stock here. There's a basket, and the index is going to be a kind of an average of all this, and it goes up and down every day. Like the examples would be the Nasdaq index, or Dow Jones, or even S&P 500, Russell 2000. Different examples. And every country also has a different index because each country has different stock exchange, different indices, and there are also sectoral indices. But we are not going too much into that. The broad market index would be, the one we are discussing here. And if you are able to invest in that index, you're getting the exposure to the overall market. So you're not worried about one single stock. Like even if one company were to go down or anything happens to one company, you're going to be affected in a small way. Like you're not going to get affected. But in the first case, if that stock fails, you're going to lose money in that stock. But in this case, you are going to lose a small portion or the entire portfolio. So you're still balanced and diversified. So that's the advantage of index ETFs. And again, here you can have income as well as capital appreciation, just similar to any stock. The third would be a little advanced. Um, it would be a little technical to explain at this moment, but I'm going to give you a brief idea. So here, this consists of a single stock, like there could be any stock like Microsoft, Apple, any company, and there would be a covered call strategy that the fund uses. So the company invests in that single stock, let's say S is the stock, plus there would be an option strategy. Let's call it OP. This is the option strategy. So the fund would own these stocks and also write options on the same stocks. So why they do that? It's a kind of hedging to generate income. Uh, Usually the stocks are bought at a certain price and the options are sold at a higher price than the stock to, to generate that profit or that income. However, keep in mind that in this case, your capital appreciation is going to be less, your income is going to be more, but your capital appreciation is going to be less. It is going to be less compared to the original stock because what is happening is you are doing some trading to, book certain profits on a regular basis. So when there is a big rise in the price of the stock, you're not going to get the entire increase. Instead, you're selling quickly and booking your profits. So simply speaking, it's basically a combination of stock plus derivatives trading, and these are done by professionals, not by yourself. Of course, there are people who do it themselves, like they have certain stocks and they write their own covered calls. But here, what we are discussing is mostly the exchange traded fund, the fund manager who is managing this portfolio. So if you understand this one, the fourth one is also kind of similar. But what is different in the fourth compared to the third is basically instead of a single stock, you're going to use a basket of stocks. That's the only difference. You're going to write uh, options on the index and hold the index as well. So in the fourth option, there is an index and there is a covered call option writing program, which the fund manager uses to generate that income. I know this could be a little technical and difficult to understand at this stage. We will definitely cover these topics when we look into covered call ETFs as we go into the future videos. But these are the overall options we have. So basically, stock, direct single stock or index ETF, or a single stock covered call ETF, or an options income ETF. These are the different options available to you as an investor. So there could be more options. Like some of you might wonder, like, are these the only options? If you know anything more or any other options or any new products that are coming to the market, please drop in your comments below. We will definitely discuss that in future videos. Okay, with that said, we'll move on to the next area, which is options in the bond market or debt market. So in the bond market, we have three options, and these would be similar to what we discussed before. First is the treasury bond. What is a bond? Bond is basically you are investing in a government paper, which in which the government borrows money from you and they pay you back in the form of interest, just like a bank deposit. You just lend your money to the government. Government pays you the interest. Interest is also known as the coupon payments. And at the end of the term, like let's say you buy a 5-year bond. At the end of 5 year, you're going to get that money back. You are going to get that principal back. So that is when the bond reaches its maturity. So what is happening in this case is there are two things again. One is you're receiving certain coupons or interest every quarter, let's say, and once the bond is matured after, let's say, 5 years, you are getting all your money back. Like they repay the entire money back to you. So you get something called a steady, reservation of capital, because your bond value is not going to change much over a period of time. Of course, it can go a little up and down, but it's going to be more or less stable, and you're going to get regular interest income, which is very valuable because you have a high level of safety and there is a guarantee that the government will pay you back. Had it been a kind of uh, you know a bond of a company or a smaller company, let's say, then there are risks because the company may not be able to pay their bondholders. So in this case, the risk is pretty low, and there are different types of bonds. It's a very big discussion. You can always invest in corporate bonds, junk bonds, and so on and so forth. But the first is the US Treasury bond or any kind of bond. The second would be like you're buying a basket of bonds. You can buy a US Treasury bond, one corporate bond, and a few municipal bonds, and so on and so forth. So in this case, TLT is an example of different US Treasury bonds packaged into an exchange traded fund. It's just like a bond fund which is packaged, and investors can invest into the ETF and get the same exposure as if they would invest in the bond. And the same concepts apply. You get regular interest or regular dividends distribution, plus you can if you wish to sell, you can get your money back. In this case, you will not have any maturity, but if you sell the ETF, you can take out your money. And the last option is slight variation of the second one. There is a bond covered call ETF, and you are buying the ETF. So the portfolio has ETF within it. Plus, the fund manager also writes covered calls. So covered calls, let's call it CC. So so the ETF portion is exactly identical to this one. So let in this case we have taken the example of TLT, which is the you know iShares bond ETF. So TLTW is a covered call bond ETF which holds TLT, and TLTW writes covered call on the same thing. So if you have this fund plus covered calls, it becomes TLTW. So in this case, what happens is you get income from the ETF plus also some income from writing of the covered calls. So there is a regular income that is being generated. So the covered call ETF will have higher amount of income, more income compared to the other two. So that's the advantage of going into covered call, but it has its own pros and cons. That is a future discussion. So in the bond market, we have these options. And can you guess what would be the next one, like next asset class that we're going to discuss? So we have discussed equities, we have discussed bonds. So what would be the next one? So some of you are looking in the right direction. That would be real estate. So real estate and mortgage funds, I both into the same category because it's kind of similar, but there are subtle differences. Okay, in real estate, some of you are already familiar, like you are familiar with real estate investment trust. So you can invest in real estate investment trust. And again, going back to the original concept that I explained, it's just different words that we are using here. So instead of income in the form of dividend, we are going to get income or distribution in the form of, um, let's say, distributions, where the real estate investment trust earning rents, and those rents will cover their expenses, costs, and all that running expenses. And then whatever is the profit, or they will be distributed to all the investors. So the rental income minus any other cost, they will distribute it. They will have a profit. That profit is going to be distributed to the investors. And similarly, if there is any plus or minus, like increase or decrease in the value of the property, it's going to be distributed accordingly. Depending on the how the uh, property performs in terms of price appreciation or depreciation, or how it moves up and down in the market. Now, taking this further, there are other types of funds which are called mortgage funds. So let's say you want to invest not in the real estate, but you want to invest in the mortgage. Basically, mortgage funds lend money to different types of borrowers. It could be individual borrowers or even commercial borrowers who want to invest in commercial property. And the fund generates income from mortgages. So that's why it says income from mortgages lent. And that income is getting distributed to the investors. So again, this is more like an income fund. So your principal or the original investment is going to stay more or less stable, or it can move slightly up or down, but it's going to be stable, but you're going to get more income. So that's the mortgage fund. Some in some countries they call it as a mortgage REIT. Uh, the concept is somewhat similar. That with that we covered the second option. The third would be the REIT index ETF. It sounds similar to the first one. The as you guessed, like this is again a kind of a packaging like a wrapper where different REITs. There is one REIT here, and there's a second REIT, and there's a third REIT. So imagine like there are different REITs, one, two, three, and they are packaged into one fund. Instead of investing in single REIT, you're investing in different REITs, so you're diversifying across different companies or different uh, funds. So that way your risk is a little lower. So that's the third option. And the fourth option would be a REIT covered call ETF. This is not recommended because this is pretty new here. And there are a few funds which are coming to the market. And I personally will not recommend this for anyone who is new or getting started. However, if you are a seasoned investor, you know how the market works and you know the real estate industry and you want to take an exposure there, this is a good option. And it's good to take a very small portion of your portfolio invested in these. Like, don't go overboard on this. That would be my general advice. However, as we move into future videos, we are going to go into specific examples. Here I'm just giving you the broad idea, and the specifics will definitely go into the specific videos in the future. So we have covered this one. There's one last area which we are going to cover, as we try to summarize this. That would be the new emerging areas like cryptocurrencies. So crypto income funds. As I mentioned in the previous slide, like I would not recommend anyone to directly jump into this without understanding what it is. So having some kind of knowledge or some basic idea of cryptocurrencies is very important. And in this video, we are not going into that aspect. We will definitely cover that in future videos. But for someone who is interested in the main cryptocurrency, blue chip cryptocurrency like Bitcoin or Ethereum, there are different options available. I have just given an example of a Bitcoin covered call ETF. The reason why I picked covered call ETF is because the traditional Bitcoin ETF will not give income, so it's not suitable for income investors. The Bitcoin covered call ETF gives income, so that way it's suitable for an income investor. So the examples of two funds which generate income would be, BTCY. It's a Bitcoin yield ETF from a company known as Purpose. The fund name is Purpose, and there's another one, YBIT, which is listed on U.S. markets, and it's a product from the Yield Max funds. And Yield Max Bitcoin option income strategy exchange traded fund. It's a big name. So these are two options where they invest in the underlying asset, which is the Bitcoin, and they also do trading or writing calls on the Bitcoin. The exact mechanics we will understand in the future when we cover one of these. And so this is another option for you, like if you want to diversify beyond the traditional asset classes. However, I would not recommend anyone putting in more than 5% of your overall portfolio into the currencies because it's highly risky. It's not something which is well established or recognized or well understood. So for anyone who is um, relatively new or I would recommend even much less. But for someone who is familiar with this, I would recommend going up to 5% of your overall portfolio. And if you have a strong understanding, probably you can go further. Uh, so with this, we have come to the end of the video. So we covered four different options. One is the equity markets options, and the second would be the bond market options. Third, the real estate or REIT or mortgage funds options. And the last was the crypto income fund options. I hope you like this video as a quick guide or start to income investing. And if you like what you see here, please subscribe to our channel. And also, if you have any comments, any feedback, or any other ideas you want to discuss, any topics you want to discuss, please drop in your comments below. And I would be happy to cover that in the future videos. Thank you. Have a good day.